Okay, let's unpack this. So when you step onto a casino floor, you know, the immediate psychological effect is just, well, it's total sensory displacement.
Oh, absolutely. It's totally by design.
Right. The architecture is deliberately engineered to strip away your sense of time. No clocks, no windows. The carpets have these crazy patterns that keep your eyes moving.
Yeah, and even the ambient sounds, right? They're tuned to these very specific frequencies that actually encourage risk-taking.
Exactly.
Yeah.
The whole environment sells this illusion of just wild, uncontrollable unpredictability. Like the next spin could change everything.
But the irony is, behind the two-way mirrors and, all the biometric surveillance, gaming is probably the most hyper-rational, mathematically locked-down business model we have today.
Oh, for sure. The house isn't gambling.
No, not at all. They are executing a statistical certainty over an infinite timeline.
And that structural tension right there, the chaotic illusion on the floor versus the cold hard math in the boardroom, that is exactly what we are tearing into today.
I love it.
Welcome, everyone, to a special Talk Tickers edition of The Deep Dive. Our mission today is to break down Boyd Gaming's Q2 2026 earnings call, specifically for you, the retail investor. For those tracking the ticker, that's BODYD.
We're basically stripping away the flashing lights to look at the raw mechanics here. Capital allocation, consumer psychology, all that good stuff.
Yeah, we want to bypass the sanitized corporate speak. We're getting you the actual story driving these numbers and figuring out what it means for your portfolio in, let's be honest, a really weird macroeconomic environment.
Really weird. I mean, the 2026 consumer environment is a massive stress test for hospitality.
Oh, definitely.
We're seeing huge shifts in discretionary spending. So looking at a diversified operator like Boyd, it's not just about one company. It's like this real-time heat map of the American consumer.
So let's get right to the headline numbers because they present a pretty fascinating paradox. Q2 2026 revenues came in at $1.03 billion.
Which is essentially dead flat compared to last year.
Right, dead flat year over year. And moving down to the bottom line, net income was $131.2 million. That's $1.75 per share, which is a drop from the $1.84 they posted in Q2 2025.
Yeah, if you just read a quick headline.
The algorithmic news scrape, right? Flat revenue, declining net income. You'd immediately think, okay, stagnation.
But you'd be wrong.
Exactly, because when you look at the metric that actually drives valuation here, adjusted EBITDA, they posted $350.5 million, which is really just a tiny marginal dip from last year's $357.9 million.
We really need to pause on that metric because for anyone holding this stock or looking to buy it, you have to understand that R at the end of EBITDA.
Yes, explain the R because it's crucial.
So regular EBITDA, earnings before interest, taxes, depreciation, and amortization.
Everyone knows that one. It's the standard proxy for cash flow.
Right. But in the modern casino industry, if you aren't looking at adjusted EBITDA with the R for rent, you are completely flying blind.
Because of the real estate, right?
Exactly. The whole capital structure changed over the last 15 years. Casinos basically realized that holding billions of dollars of dirt and steel on their balance sheets was, just incredibly capital inefficient.
Yeah, that it sold it all.
They executed these massive sale-leaseback transactions with REITs real estate investment trusts like VCI or gaming and leisure properties. Boyd sold the buildings, took the cash for acquisitions and buybacks, and now they just lease the properties back.
On these massive long-term triple net leases, meaning they have colossal mandatory rent obligations built in now.
Right. So if you just look at standard EBITDA, it looks artificially low because of those rent payments. Adding the rent back in isolates their pure operational efficiency.
It tells us how good management actually is at running the food, the hotel, the casino floor, totally separate from their real estate strategy.
And when you isolate that, you find what I think is the most insane data point in this whole report. Despite flat revenue, Boyd's property operating margins held absolutely rock steady at 40%.
40%. I mean, I have to stop you there because that just defies the gravity of the 2026 economy.
It's a massive flex.
It really is. We've got sticky inflation. We've got aggressive wage pressures. The cost of food and beverage goods is way up.
Not to mention utilities.
Oh my gosh. Yes. Cooling millions of square feet of casino space in Vegas during the summer. The energy costs are astronomical.
So to hold a 40% margin, meaning they keep 40 cents of pure profit for every dollar walking in, it's just a masterclass in operational efficiency.
But it wasn't easy, right? Like looking at the Q&A and the transcript, John DeCree from CBRE really pushed them on this.
He did. He noticed their flow-through was exceptionally strong, especially in the Midwest and South. And Josh Hersberg, the CFO, was surprisingly candid about the internal struggle they had last year.
Yeah, Hersberg basically admitted they hit a wall in the back half of 2025. They had revenue coming in, but the profits were just vaporizing.
Total margin compression. And it was mostly benefits and healthcare costs, which are just silent killers on a labor-intensive balance sheet.
Right, if management isn't watching those daily, they will eat you alive.
But what's fascinating here is how fast Boyd reacted. CEO Keith Smith talked about how the property managers instituted this obsessive daily focus on expense controls.
It's the unglamorous stuff.
Exactly. Restructuring benefits, recalibrating labor schedules to match foot traffic hour by hour, clamping down on buffet waste.
Dynamic HVAC adjustments in empty convention halls.
Yeah.
Just blocking and tackling. And the result is that 40% margin.
Which is the ultimate safety net for the stock price right now.
So the machine is running flawlessly underneath, but we have to break down that flat revenue number because it's actually a tug-of-war between two totally different stories.
It really is an average of two extremes.
Historically, Vegas was the superstar slugger, right? The indestructible profit engine. And the regional casinos were just the reliable bench players. But in Q2, that totally flipped.
The regionals are carrying the team right now. Look at the Midwest and South segment. We're talking Illinois, Indiana, Ohio, Louisiana. Drive to markets.
Riverboats and racinos.
Right. They generated $556.9 million in revenue. That's up 3.1%. And the EBITDA was up 3.6% to $208.7 million.
And those margins we just raved about. The Midwest and South actually expanded their margins to nearly 38%. The highest in 2 years.
So they have top-line growth, bottom-line growth, and margin expansion in the so-called unglamorous markets.
So why is that happening? What is the shift in the consumer here?
Keith Smith said their data shows guests are choosing to stay closer to home. They are consolidating their entertainment spend locally, and it's all about travel logistics and macro friction.
Right, let's put ourselves in the shoes of that core retail gambler. Say a guy in Ohio has a $2,000 annual budget for gaming.
Okay.
Getting to Vegas right now is brutally expensive. Airfares are structurally high. You've got the Ubers, the insane resort fees, the $20 cocktails on the strip.
By the time he sits at a blackjack table, half his bankroll is gone.
Exactly. It's vaporized by travel friction. But that same guy can drive 45 minutes to a local Boyd property in Ohio, sleep in his own bed, and put the entire $2,000 on the floor.
They're prioritizing value. Smith did say high net worth folks are still flying in unbothered, but the middle tier consumer is feeling the inflation pinch and pivoting hard.
Which perfectly explains the drag on this quarter. Las Vegas.
Yeah, Nevada was the clear headwind.
But we need to separate the macro weakness from the self-inflicted wounds, right? Because there are two distinct problems happening. First, the destination softness.
Hersberg quantified it.
Yeah.
He said destination softness was a $5 million hit to EBITDA for the quarter.
And he was so blunt about it. No spin at all.
None. He basically said, we've taken this hit for a few quarters and we expect it to continue.
Yeah, his phrasing was, they don't expect it to flip positive. They just expect it to be, quote, less bad.
You never hear that kind of capitulation on a call.
Never. They're openly admitting that properties like the Orleans, which rely heavily on tourists, are trapped in a shrinking demographic right now.
But that $5 million is only part of the Vegas drag. The other part was totally self-inflicted. Suncoast.
Right. $3 million in EBITDA lost purely to construction disruptions at the Suncoast property. And they forecast another $3 million hit next quarter.
$3 million sounds like a rounding error, but if you know casino operations, a major remodel is dangerous.
Oh, it's catastrophic to short-term yield. You put up walls, you unplug hundreds of slot machines, and every unplugged slot is basically a dead ATM.
You've got dust, noise, you lose parking to construction crews.
And the locals in Vegas. They are creatures of habit. If you annoy them, they don't stop gambling. They just drive 2 miles to a station casino instead.
Customer loyalty is super elastic for locals. So between the Orleans taking a $5 million hit and Suncoast taking $3 million, the aggregate Vegas locals revenue dropped to $225.9 million.
Which looks bad on paper, like the Vegas local is tapped out.
But that's the illusion, right?
Yes. Because if you parse the transcript, there's a hidden gem. If you carve out the Orleans and the Suncoast and look just at the pure local spots, Sam's Town, Gold Coast, Aliante revenue actually grew by 4%.
Wait, really? 4%?
4%. The true organic Vegas local is actually spending more often.
That totally reframes the whole Vegas thesis. Why is the local doing so well when the rest of the country is tight?
Smith dropped a massive macro stat. Southern Nevada employment is growing faster than any other major metro in the U.S. They've added 200,000 non-hospitality jobs in the last decade.
Wow. So it's not just dealers and bartenders anymore.
Exactly. It used to be a closed loop. If the Strip suffered, local suffered. But now you've got tech, logistics, healthcare, pro sports.
It's a diversified economy.
And weekly wages there are growing at double the national average. So Boyd isn't just a secondary tourism play. They're leveraged to one of the strongest localized economies in the country.
Which explains why they are fine taking a $3 million hit to remodel Suncoast. They know the customers in that zip code have the rising income to support a much more premium product once the walls come down.
Okay, so that perfectly transitions us to guidance and capital allocation. We know the regional consumer is strong, the Vegas local is strong, but where is management steering the ship?
This is where things get a bit tense.
Yeah, because frankly, as an investor looking at this transcript, I was alarmed by the CapEx guidance. They spent $142 million in Q2 alone.
Almost $300 million year to date.
And they reiterated a full year 2026 CapEx budget of $650 to $700 million. I mean, are they spending too much on renovations instead of just keeping the cash? It feels like classic casino empire building.
It's a fair worry. This industry loves to incinerate cash on over-leveraged mega projects. But if you actually break down that $700 million, it's highly targeted.
Okay, contextualize this for me. Defend this spend.
First off, about $250 million of that is just baseline maintenance.
Just keeping the lights on.
Right. HVACs break, thousands of slot machines need tech upgrades, carpets get destroyed. If you don't spend that $250 million, you lose that pristine 40% margin because the product degrades.
Okay, fine. Maintenance is table stakes. But what about the other $400+ million?
About $75 million is going to comprehensive room remodels, like finishing the Orleans. By 2027, they'll have refreshed over 70% of their Vegas hotel inventory.
Which makes sense. If travel is expensive, the room better be flawless to justify the trip.
Exactly. But the big ticket item, the real growth engine, is the Norfolk, Virginia resort. They're dropping $300 million into that just this year.
Norfolk. This is a ground-up 65,000 square foot casino on the waterfront, opening late 2027. But I have to ask, why Virginia? Does the data support a $750 million build out there?
It actually does. Smith laid it out perfectly. Hampton Roads has 1.8 million permanent residents, plus 15 million tourists passing through Virginia Beach every year.
And very little competition, right?
Almost none for high-end gaming. It's a massive vacuum. And Herzberg was specific. They are targeting a 15% cash-on-cash return in its second year.
Wait, 15%. Let's translate that. If the project costs, say, $750 million total, a 15% return means it throws off over $110 million in pure annual cash flow once it stabilizes.
In this interest rate environment, that is an unbelievable yield. That's not empire building. That's structurally elevating your free cash flow for the next 3 decades.
And Norfolk isn't the only move. They're also spending to convert the Amelia Belle in Louisiana from a riverboat to a land-based casino.
Which is such a fascinating quirk of the Deep South markets. They used to mandate that casinos had to be on the water.
Floating barges. So inefficient. Low ceilings, terrible sight lines, maritime maintenance costs.
Right, but regulations have modernized. Moving inland lets them expand the floor, optimize the slot layout, and just make it a vastly better experience. It's a low-risk, high-reward play.
Okay, I'm seeing the logic. And what's crazy is, while the physical casino revenue was flat, they actually raised guidance for their digital and managed segments.
Yeah, this was subtle but huge. They bumped online guidance by $5 million, projecting $35 to $40 million in EBITDA.
Which always confuses people. You don't see a Boyd Sportsbook app everywhere. Where's that profit coming from?
2 buckets. First, market access agreements. Basically, huge players like FanDuel pay Boyd just to operate under Boyd's physical licenses.
It's just regulatory rent.
Yeah.
Zero marketing spend, zero risk. Just $12 million falling to the bottom line.
Yep. The second bucket is their own iGaming platform, Boyd Interactive, digital slots and tables. It's booming because of that same desire for localized convenience we talked about earlier.
And they also raised managed business guidance by $3 million.
Driven by the Sky River Casino in California, Boyd doesn't own it. The Wilton Rancheria tribe does. Boyd just operates it for a fee.
And it grew EBITDA by 18.2% year over year. They're already greenlighting a massive phase 2 expansion for early 2028.
And that requires zero CapEx from Boyd. The tribe funds it. Boyd just collects a frictionless hyper-margin management fee.
Okay, so the CapEx is justified. But here's where it gets really interesting for the stock. They were doing all this building, but they are relentlessly buying back their own stock.
The buybacks are the big hook here.
They repurchased $156 million in Q2. That's 1.9 million shares taken off the market at an average of $83.60.
And the cumulative effect is what investors need to hear. Herzberg noted that since late 2021, Boyd has reduced its total share count by 35%.
That is just staggering, a 35% float reduction. If you bought this stock in 2021 and just sat on your hands, your ownership of the company grew by a third just because management is vacuuming up the shares.
It acts like a sponge for value. Even with flat net income, your earnings per share stays elevated because there are way fewer shares in existence.
Keith Smith said they aren't stopping. They have a floor of repurchasing $150 million a quarter. Between that and the dividend, they are on track to return $650 million to shareholders this year.
Which is like $9 a share, while simultaneously funding $700 million in growth projects.
And their balance sheet is still pristine. Leverage is only 2.2x. Even LEAF adjusted for all those REIT payments, it's just 2.7x.
They're funding everything purely from the free cash flow generated by those 40% margins. It's a totally self-sustaining ecosystem.
Which brings us to the bottom line. For you listening, holding or considering BYD, what's the verdict?
I'd say cautiously bullish.
Same. Cautious because management was dead honest that Vegas destination traffic is not recovering anytime soon. It's just going to be less bad.
Right. But bullish because of the 40% margins, the massive regional growth, and that $150 million quarterly buyback floor. It creates a massive safety net for the stock. If the market sells off, Boyd just steps in and buys its own dip.
It really is a beautifully calibrated machine. But I want to leave you with one final provocative thought.
Lay it on me.
We're watching regional drive-to-casinos absolutely crush it right now. Boyd is dumping hundreds of millions into Virginia and Louisiana. So if sustained travel costs make Vegas too expensive for the middle class, and regional spots are offering luxury experiences 45 minutes from your house, are we seeing a permanent industry-wide shift away from the Las Vegas Strip as the undisputed king of gaming?
Oh, that's a great question. Vegas has the spectacle, sure, but convenience and quality in the regionals are closing that gap fast. People are voting with their localized dollars.
The geography of entertainment is shifting, my friend, while tourists are mesmerized by the flashing lights on the floor.
The real money is looking at the hyper-rational math and margin defense in the boardroom.
The math always dictates the outcome. Thanks for tuning into this Special Talk Tickers Deep Dive. Watch those margins, keep an eye on the regionals, and we will catch you on the next one.